As we move into capital markets, we need to understand interest rates and the interest and how it's determined. And if we think of prices as a means of allocating resources today, interest rates are a means of allocating resources through time. And so we're going to take a look at how interest rates are determined and then the effect of interest rate controls and things like that. So let's start off with a simple question. Why must a bottle of scotch aged for 12 years sell for more than a bottle of scotch aged for 2 years? Now, many people will say, well, the bottle of scotch aged for 10 years must taste better, or 12 years must taste better than the bottle of scotch aged for 2 years. Well, certainly that could be true. People wouldn't buy it if it didn't. But if the costs were the same, competition would drive that price down to the 2-year-old bottle of scotch. So it has to be more than just the demand side. We also want to look at the supply side. Similarly, why must red peppers sell for more than green peppers? And we think of a red pepper, it's just an over-ripened or actually a ripened green pepper. Same with a yellow pepper, and they sell for much more than green peppers. And why must raisins sell for more than equivalent number of grapes? Raisins are dried grapes. There are a number of things we can look at with this, including why cheese must sell for more than milk, and why a 10-foot or 8-foot tall Christmas tree must sell for more than a 6-foot tall Christmas tree. And so we're going to take a look at this, and the reason, the answer we're going to look at is what's called the time value of money. Money, your money is time. Well, for me to defer consumption today, you're going to have to compensate me. So let's say I could sell 100 gallons of scotch for $50 per gallon. That's $5,000, and I could put that money in in some investment today that's going to earn me 10% over the next 10 years. Well, if I do so, I'm going to end up with $12,968.71. So if you want me to sit on that bottle or that scotch for an additional 10 years, you're going to have to compensate me at least an equivalent amount of what I could earn having put that money in some other investment, what other opportunity cost I have. And so in this case here, you would have to pay me at least $130 per gallon of scotch to hold on to that scotch for an additional 10 years. And this is really what we're going to look at, where interest rates come about. What's behind an interest rate, it's not simply an arbitrary decision of here's the interest rate. It's based on people's time preferences. And so we think of making trade-offs. Again, we make trade-offs every day. I chose Coke over Pepsi. I picked up a shirt instead of a DVD. I went to a movie instead of dining out, etc. These are decisions we make every day, and they're trade-offs. And we also do the same with intertemporal choices. Do I buy the pair of shoes? They're not the ones I really want, but they're cheaper. I could buy them today, or I could hold off and put this money in the bank and wait till I can afford the other pair of shoes. Do I buy, a new car, or do I save off and save for that and save for retirement? Do I take a European vacation today, or do I save for a down payment on a home? Do I borrow money for school, or do I do something else and bring that consumption forward? And these are choices we make intertemporally. And what that simply means is I could consume something today, or I could hold off and consume another thing of even more value in the future. And so what determines whether I consume today or save for later is what's called my time preference. Okay, my time preference is how interest rates are really determined. So if you think of time preference as my willingness to defer consumption, one example of this it's probably, I think the truth of this study is out, that it's not necessarily a valid study, it was manipulated, but the storyline is still pretty interesting for this. They did experiments with young kids. They put them in a room, they put a marshmallow on a plate, and then the researcher said, I'll be coming back in a little bit, I have to leave for right now. If that marshmallow is still on the plate when I get back, I'm going to give you a second marshmallow. And they left the room. Some of the kids immediately picked up the marshmallow and ate it. They didn't get another one when the researchers came back, but the other ones who looked at it, they smelled it, they licked it, and whatever, they still kept it there. They got the marshmallow when another marshmallow when the researcher came back. So the first ones who ate it have what's called a very high time preference. They're not willing to wait and defer consumption. Those who waited have a low time preference. They're willing to wait. They're not as impulsive. So we think of interest rates and as prices. It's the price a borrower pays in order to move their consumption forward. I could buy a car today and go ahead and borrow money to do so, and I'm going to pay an interest rate instead of somebody else not consuming that money, I'm going to borrow their money to buy a car. Additionally, I could just work for 5 years, save the money, and then go out and pay cash for a car, but I want the car today, so I'm moving that consumption forward, and the interest rate I pay on the loan is the price I pay to move that consumption forward. The lenders receive interest for deferring their consumption, so the person who lends the money gets compensated in the form of interest payments, and that's basically the rate is the price that they're getting paid for deferring their consumption. And some with very, very high time preferences really want to consume today, and therefore they need a really high interest rate in order to save. They're not willing to save at lower interest rates, and they want to go ahead and consume a lot today. They're not willing to save for the future. And there are other people with lower time preferences, and they're willing to save for the future. They don't need as high an interest rate in order to save. If we look at then supply and demand for loanable funds, and with loanable funds we're talking about whether it's debt markets, so bonds, it could be money in the bank, some forms of lending, that will be on the x-axis. On the y-axis we're going to have interest rate, and here is our demand for loanable funds. As we say the demand is, the curve is sloping downward, which means the lower the interest rate, the more I'm willing to borrow. If I asked you if you're willing to borrow $100 at 20% interest, you're probably going to say no. But if I say, are you willing to borrow at 1% interest, you're far more likely to say yes, and you'll borrow a whole lot more. So the downward sloping demand curve shows us that there are some people who have a very, very high time preference. They're willing to pay a high rate of interest. They'll be more to the left. And there are others who, if you want me to borrow, you have to lower the interest rate. They'll be more on the left. And there, by the way, the demand is going to be the borrower, and the supply is going to be the lender. And this is upward sloping, which indicates that people with higher opportunity costs of their funds are going to need more coaxing in order to lend their money. They need a higher interest rate. And the higher the interest rate, the more of these people are willing to put their money in banks or lend it out in other ways. And we end up with our equilibrium amount of $50 billion, loanable funds notices in billions of dollars, and the interest rate here is going to be 8%. So this is the equilibrium in our market of people who want to borrow money, they have a desire to move consumption forward, and those people willing to lend money, they have a desire to defer consumption, and those people meet at this equilibrium. 8% is the equilibrium rate, $50 billion is the amount being borrowed. Anything to the right, the desire to consume is greater than the desire to borrow, or the opportunity cost of lending is greater than the value to those people borrowing it. Anything to the left means that there are people who the opportunity cost is lower relative to the value of those who want to move their consumption forward. So this equilibrium, we tend towards this 8%. We have here the borrower surplus in the, just like a consumer surplus, but here the borrower gains surplus. They're willing to borrow at a higher rate, but they only had to borrow at 8%. And then we have the lender surplus, which is the amount lenders receive above and beyond their opportunity cost. And at the bottom, much like variable costs in a market, this is the opportunity cost of lenders' funds, what they could have done or the return they could have earned elsewhere. Now, we can look at an increase in the demand for loanable funds, and we see that the demand increases, which causes the interest rate to rise. As more people demand to bring consumption forward, you need to coax more people to lend that money out to them. That requires a higher interest rate, and therefore that's movement along the supply curve. This increase in demand led to an increase in the interest rate. Conversely, we could have a decrease or an increase in supply of loanable funds, more people willing to lend, and therefore the interest rate falls. These are people who they're now wanting to lend at lower interest rates or willing to, just because that opportunity cost may have fallen, and therefore they're now lending at 4% instead of 8%. These can go in either direction. You could have a decrease in supply and you could have a decrease in demand. The same thing, but just the opposite effects. I'm just looking here at what happens when the demand and supply in loanable funds changes. Last thing I want to look at is what happens when you have a rate ceiling on interest rates. And in this case here, we're going to have a 5% rate ceiling, which says you can't charge more than 5% interest. Usury laws used to be in place in many places, and we also had laws in this country that restricted charging or paying interest above a certain amount. And so let's say that the market interest rate is really 8%, but you can't charge more than 5%. What happens is the amount wanting to be borrowed is much greater than the amount available. So here we have 65 billion as wanting to be, people want to borrow at this rate, yet people only want to lend 35 billion. So now you have a shortage of $30 billion. Now there are other ways of dealing with this we'll talk about. For example, when you did have usury laws in medieval, or actually in the Renaissance in Florence, there were ways of getting around this. For example, the Medicis were notorious for lending money in florins, and then you had to repay in another currency, and they would simply manipulate the currency rate to make up for the loan. So there are ways that this would be worked around, but the official rate is 5%. What's worse than this is, at this 5% rate, the amount that people really want to borrow at this quantity, people are really willing to pay a lot more. Let's say they're willing to pay 12%, but they can't. But that means that these people with really high value for these loanable funds, this could be people who have very good investment opportunities, or people who really want to bring consumption forward. They may not get the loans because those people further down the demand curve are just as likely to get them. And so some way of allocating these scarce resources has to come about, and putting the interest rate ceiling really blocks that from happening and leads to perverse outcomes.